want to thank everybody for joining today and taking time out of their Saturday morning to join and come listen to us. The goal for the webinar, the goal for the chat is to teach you guys about passive real estate investments. A lot of my insiders, a lot of my um, database clients have just been asking me what are other options, what's happening with the market. So I figured let's do a chat where Lawrence will give us details about what passive opportunities there are and how we can tap into the market without going the route of buying a property or having a 10%, 20% down payment. Okay, so I'll pass the mic on to Lawrence. Before I do that, I just want to introduce Lawrence. Lawrence is an associate vice president at Equiton Capital, leading the Toronto Capital Market Division. He's been a real estate professional for 6 years and a real estate investor for 14 years. He bought his first investment property at the age of 23 years. Today, Lawrence manages 12 doors and various passive real estate investments, which will be the subject of today's presentation. Beyond his real estate experience, Lawrence holds an MBA specializing in investment management from Concordia University in Montreal. So I'll pass the mic on to Lawrence. He'll take it on from here, and can't wait for what he has to share.
Thank you, Majid. Even in hearing the introduction, I just looked down and saw that there's multiple participants in the room, and I thought that you and I were just having a one-on-one conversation earlier. So maybe too much information for the group of people here today. But now you guys have learned a little bit more about me, I guess. Yeah, so maybe just to build on Majid's intro, which was excellent, by the way. I'm Lawrence, a VP at Equiton Capital. I've been a real estate investor for the past 14 years. I started when I was 23 years old by purchasing a student rental. And I didn't know it at the time, but it completely changed the trajectory of my life, my personal career, of course. And I've had some pretty favorable results from real estate investing. And today, we're going to be discussing some of the ways that folks can get engaged into real estate investing, but without many of the hurdles prevalent in this industry. Now, in my talks with clients, and I do this for a living, there are generally three major hurdles to real estate investing. Majid touched on a few of them. Number one is the massive down payment typically required. Number two, the need for financing, especially at today's high interest rates. And number three, of course, is you're effectively a landlord, right? So insofar as you can meet the financial commitments, you've effectively taken on a part-time job. Some people enjoy that quite a lot. Some people are not well suited to this type of real estate investing. And so for the investors that are not either financially able to invest in real estate or don't have the time or wherewithal to make the commitment, passive real estate investments are an excellent option. That's what we'll be speaking about today. So before we take a deeper dive into our various investments and strategies, I think it might be useful to take a step back and discuss who we are at Equiton, because we do have a pretty strong history and track record of success. Now, we had started our company back in 2016, and at that time, there were only 3 employees, 3 of us. Today, we manage a portfolio of over $1 billion worth of real estate assets. We have over 200 employees in 2 different offices, one in Burlington, Ontario, one downtown Toronto. And we are what I would call a fully integrated real estate investment firm. And that is just a fancy way of saying that we do everything in-house at Equiton. So for instance, when we discuss our residential investment fund today, you will know that we do all of our own property management in-house. They work for Equiton, our property managers. And if we discuss our development opportunities, you will know that Equiton Developments, our development arm, presides over the project. Everything is done within the Equiton ecosystem. This is extremely rare. Typically, investments like this are built upon partnerships where there is a capital partner and an asset manager. We do both of those things here at Equiton. So why invest in private real estate, right? Now, at Equiton, we are a private and passive real estate investment firm. And those are 2 key words that I'd mentioned, the 2 Ps. First of all, for you, this is a passive investment, right? You're getting physical exposure to real estate, physical brick and mortar assets. However, you don't need that massive down payment. Of course, you don't need financing and you don't need to be a landlord. For you, this is passive. You're taking part in the appreciation of the buildings and in the cash flows they generate without the day-to-day ongoing management and expense. You're leaving that to the professionals at Equiton. However, we are also a private company. We are what some would consider private equity. And this is a very important part to start the conversation because we are not a stock, we're not a mutual fund, we are not traded on the public stock markets. And because we are not traded publicly, we are able to give investors a financial investment that is much more stable and much more consistently able to deliver profits. There is very, very low volatility with these types of investments. They are very, very consistent at delivering returns. In fact, I can tell you that no investment at Equiton has ever dropped in value. It has never happened. So these are, in fact, very, very stable investments. And the reason why is because predominantly we are investing in privately owned Canadian apartment buildings. We own apartment buildings across the country on behalf of our investors. And we can see from this chart here, over the past 32 years, this asset class of Canadian apartment buildings is incredibly stable. It, in fact, is also never dropped in value. And this is including weathering the storm through multiple financial crises, right? The global financial crisis, GFC in 2007, 2009, most recently COVID, and yes, the precipitous cost run-ups borne by the inflation crisis we're going through even today, right? Very, very stable, very strong asset class. Now, at Equiton, we're a quite simple company. We only have 3 investments. It's very, very simple. But even to break it down to even be more simple, you can put those into 2 major buckets. On the one side, we have real estate funds. And on the other side, we have real estate developments. Okay, funds and developments. And we're going to kind of pick those 2 apart into their respective categories and walk through each of them today at a high level. So on the fund side, the first thing to be aware of with our 2 funds is, number one, they're diversified. So if a client of mine is going to make an investment in either fund, they are going to share in the ownership of not just 1 or 2, but multiple buildings, an entire portfolio. Could be as big as 35, 36, 37 buildings. And that diversification, of course, lowers risk. The second thing to understand about the funds is that they both produce monthly cash flow. Both of our investments pay monthly distributions to clients. And you can think of that to be identical to the rental income you would generate if you had rented out your own property, right? We're doing the exact same thing. We're giving our investors cash every single month coming from the rental income of our buildings. And the third thing to understand is that the investments are easy to move in and out of. They're quite flexible. We like to say they're liquid. You can buy and sell them more or less at your leisure. However, I always caution my investors, these are not short-term investments. You should not be day trading any Equiton funds because after all, we are investing in physical real estate. And so we are looking for a commitment of time from our clients of a few years. So you should be comfortable with a few-year time horizon for your investment, okay? Now, forget about the funds for just a moment. I'd like to talk about the developments, the 16 to 20% annual returns that you're going to see here on the far left. So the developments are entirely different investments. With the development, we are investing in the physical construction of a real estate asset, most notably a condo. So it's a residential asset, and we are profiting when that building is completed and subsequently sold. Okay, so this isn't a long-term buy and hold approach, nor are we selling units pre-construction. So what we're discussing today is not the opportunity to buy a unit pre-construction. We are investing in the physical construction of the building. Our exit strategy is when we actually sell pre-construction. That's the source of our profit. So we are acquiring a parcel of land. We are going through the rezoning process. Once we get that site plan approval and draft plan approval, we're digging a hole in the ground, pouring concrete foundations, building up and up and up. We're doing all of that in-house. And of course, when the building is completed, we're handing over the keys to the very excited purchaser, and that is our source of profit. Now, at that time, we are exiting the investment. So investors at the end of the project get back all of their original investment, plus any and all returns, and the investment closes down. So the first thing to know about developments, unlike the funds, they are not diversified. It is a concentrated investment. You're getting exposure to one specific project, whether it's a townhouse complex in Brampton or a condo in Toronto or a subdivision of homes in Ottawa, whatever the case may be. The second thing to know about developments, unlike the funds, is that they do not produce cash flow. There's no monthly income associated with the investment. These are longer-term projects with very high growth, but that growth comes on the tail end of the project. So if you're on a 6-year project, you're going to get your money back and your profits at the end of that 6th year. Nothing from years 1 through 5. The third thing to know about the developments, and this is critical, unlike the funds, which are relatively flexible, you can purchase investments on an ongoing basis. You can sell them more or less anytime you'd like. The developments cannot be sold. Okay, they have a hard holding period of the life of the project. So if you're on a 6-year project, you can't decide 3 years in that you no longer wish to hold it. We will refuse your sale. So these are quite restrictive investments with no cash flow. However, you're compensated for the level of restriction in the form of some very, very high returns. The rule of thumb with development projects, you guys, is that on a 5-year project, you stand to double your money. So the return on investment, the ROI, should be around 100%. Okay, that's how these things work. And when you understand that, if you do 2 or 3 projects back to back to back, if you have that time horizon, you can see how powerful they are, because you're going to double your money 3 times over. That's an 8x return, right? First it's to 2, then it's to 4, and then it's to 8. So the returns can compound on themselves with some very, very favorable results if you have the time. Now, bringing it back to talk about the whole at a high level, these investments are very different and they're suitable for different types of people, right? If you're maybe an older woman or gentleman, you're maybe approaching retirement, you're looking for some consistent cash flow to supplement your retirement lifestyle, the funds may be something more appropriate for you. However, if you're a little bit younger, maybe you have some money in a TFSA or an RRSP, and you don't really have a desire for cash flow, you're working full time and you have decent income, well, then the developments are going to be much more appropriate for you. And because our investment minimums are not overly high, I find that I'm often accommodating investments across multiple investments, right? So we're not putting all of our clients' eggs into one basket. We're going to diversify across 1 or 2, maybe even 3, and come up with a portfolio that makes sense based on what my client is trying to achieve. And that's my job at Equiton. I'm getting to know my clients and I'm making their allocations based on what we both deem to be prudent. I touched on a few things there very quickly, and I want to just double click into them a quick second. So I talked about investment minimums very, very briefly. The minimums for the investments, like I mentioned earlier, they are quite low. We have minimums as low as $10,000. Okay, so this middle fund here, the Income and Development Fund, has investment minimums as low as $25K. The 2 corners, the residential fund, or the apartment fund as we call it, and the development offerings, these both have minimums of $25,000. Okay. And the second thing I mentioned earlier that I want to go into is the fact that we can use registered accounts. This is a game changer for most real estate investors because many of you should know as well as I do, it's very difficult to invest in physical real estate using your TFSAs, your RRSPs, maybe an old LIRA from some previous employer, or an RESP if you have kids, which I do. So these registered accounts are very, very popular choices for these types of investments. And yes, we can accommodate all of the accounts I just mentioned. TFSAs, RRSPs, LIRAs, RESPs, all of these are eligible for Equiton's investments. So I find I'm doing most of my clients' investments through these accounts to shelter against tax, naturally. So we're going to take a deeper dive into each of the investments just at a high level, just to give you guys a better understanding of how these things work. We're going to start with the apartment fund, and I don't mean to give bias right up front, but I'll tell you that this is my favorite investment at Equiton. It's my weapon of choice. It's our oldest and consequently our largest fund. And from a strategic perspective, it is very, very simple. It is the same strategy you would employ if you decided you were going to go out and buy your own investment property yourself. It is a long-term buy and hold approach to residential real estate investing. The difference with this fund is that we are investing in high density residential. So we are buying 20-story apartment buildings valued anywhere between $20 and $70 million. We're not buying houses, we're not buying individual condos or townhomes. We're buying full entire buildings. And we do employ what's called a value add strategy. And that is just a fancy way of saying that we target for acquisition buildings that are currently under-optimized. They're not performing where they should be today. And there's a multitude of reasons why that may be the case. Maybe the current buyer or the current owner is not investing in the property. Maybe they're not as savvy as they think they are, and so they're not really maintaining the asset. Maybe the tenants are just on older rental agreements, and we don't have an ability of raising rent as much as we want in this province, and so they're paying below market rent, many of these older tenants. We see these buildings as opportunities because we can acquire them at very attractive valuations. And once we do so, our property management team, all of which is done in-house, will get in there, roll up their sleeves, and maximize not only the value of the property, but the amount of cash flow it generates. So those two things go hand in hand. Now, in terms of the size of the fund, it is absolutely massive. We have 960 million worth of property in this fund today. Okay, so it's very, very large, very, very stable. Over 11,000 investors currently in this fund alone, all across Canada and even the world. And in terms of individual apartment units, just over 2,700. However, those 2,700 apartment units are spread out across 34 buildings. So 27 units, 2,700 units, only 34 buildings. So now you can get a sense of the density, the size of the buildings that we acquire. Now, geographically speaking, we have a national investment mandate. We can invest anywhere in the country, never outside of our borders. However, most of our properties are located right here in southwestern Ontario. So these are going to be markets that most of you are very familiar with, right? We have properties as far east as Ottawa and Kingston, as far west as, I would say, London and Chatham. Okay. Now, I included a few clip art shots of some actual acquisitions that we had made in October, November of last year, just so you guys can get a sense of the type and of the quality of building that we are purchasing. So this was a property that we were purchased in London, Ontario, 470 Scenic Drive. This is our second property in the city of London. We intend on buying more. It's a very nice rental market. But you can see very nice, very clean building, good pride of ownership. It's in good shape. And these are the types of buildings we're going after. Second one we had purchased in 2023, again, just at the tail end in December, in Brantford, right? We paid just over 11 million for it. Again, nice looking building, high density. This is what we're going for here. Now, the total targeted return for this fund is 8 to 12%. You may have garnered that from that overview slide earlier. However, that 8 to 12% is broken down into two categories. Part of that 8 to 12% you're going to receive through cash flow, right? I mentioned earlier that both of our funds pay cash. So you're going to receive a monthly cash distribution of about 5.8% as of today. And it's going to fluctuate. Sometimes it goes up, sometimes it goes down. That's why we put 5 to 6. Currently, we're paying 5.8% in cash. The remaining 2 to 6% is going to be the appreciation of the buildings. So as the value of the portfolio increases, we raise the unit price, the value of the fund, so that your nest egg, your principal investment, also goes up. So if you invest, let's say 25,000, you're going to receive a certain amount of monthly cash flow, but at the end of the year, that 25,000 is going to be worth 26,000 or 27,000, whatever the case may be, right? So capital appreciation and cash flow are part of that 8 to 12% return. We can look at some real world results to see how this fund has actually performed. And I mentioned at the beginning, no investment at Equiton has ever dropped in value. That's the reason why I'm a personal investor in this fund. I absolutely love it. It averages 10% a year, in fact, slightly higher, and it never drops in value. Not in any month, not in any quarter, never. It has never happened. These are the actual returns that you would have received had you invested in the fund from day one. You can see this chart never goes down. And for those of you that invest in the stock market, I want you to picture any stock chart in your mind today that you've ever seen on TV or in your investment portfolio statements, whatever the case may be. Compare the volatility, the up and down of that chart with the smoothness of this chart. This chart goes up and to the right. It doesn't go up and down like a roller coaster or like a yo-yo. It is very consistent. This is why I see so much value in this investment for myself and my family. Consistency is very important because the more consistent your returns, the lower the risk, right? Now, for those of you that are number focused, we can have a look at the numeric returns that we've enjoyed over the last 7-8 years. Our 5-year annualized return, you can see in the bottom table, 5 years, 10.6%. So on average, that is what this fund will do for clients. Last year, we did 10.81, 2023. That was our calendar return. Okay, very stable, as I mentioned. Now I'm looking up at the time and I'm going a little long on the tooth here, so I'm going to pick up the pace a bit here. Just to close on the apartment fund, again, it's a long-term buy and hold approach to residential real estate. It's the same thing you would do if you went out and bought a condo or a townhome and rented it out yourself. It's the exact same thing. You're getting profits two ways, a combination of capital appreciation as the buildings increase in value and cash flow, that 5.8%. The total return is targeted to be 8 to 12% every single year, and our annualized 5-year return is about 10.6%. Very strong. It's also never dropped in value. So now let's move on to the second fund we offer at Equiton. Now it shares many similarities to that apartment fund, so we're going to go through it a bit quicker, but I do want to point out some of the differences. I will tell you, it is a better performing fund. We target higher returns. We target 12 to 16%. Now this fund on that overview page sat in the middle. And the reason why it's in the middle is because it actually has pieces of either corner. Part of the fund is invested in very consistent, very stable investments that produce monthly income for our clients. But the other part of the fund is invested in higher growth, but longer term real estate development investments. So it's meant to be a hybrid. It's a jack of all trades type of investment. And let's talk about the income side first, and we'll breeze through this because it is similar to the apartment fund. It has monthly cash flows. It's the cash flows have never been missed, never been lowered. We pay out 6% in this fund. And there are two asset classes responsible for the monthly cash flow. The first is commercial properties. Again, it's a long-term buy and hold approach to commercial real estate investing. And the second piece is a little bit of private lending. So there's an element of this fund that is private debt, not private equity. Okay. Now, again, these two asset classes are responsible for that monthly cash flow paid on the 15th of every month. And again, 6%. I want to spend most of our time today talking about the development opportunities, okay? Because it's the development opportunities that generate most of the profit in the fund. Most of that 12 to 16% is coming from the completion of development projects. And so I want to walk you through them. The way the development profits are shared in this fund are as follows. When we finish a development in this fund, you are going to receive a special dividend. It's a one-time cash payment made out to investors to allocate them their share of the profits of that development completion. Now, in the fund, there are multiple development projects. So it's a great way to get exposure to not just one, but many different developments, which is typically very difficult to do when our standalone development projects have a minimum of 25K, right? So that's why this fund has a lot of value for investors. It's diversified. So we have 3 developments in the fund currently, all of which are residential, and we'll walk through them at a high level now. So our first one coming up for completion in either Q4 of this year or Q1 of next year is a 96 stacked townhome development in Guelph, Ontario, right? 710 Woolwich Street is the address. This is coming up for completion, just as I mentioned, in about 12 months, a little bit less, and we're currently under construction on this project. So we're actually just finishing it up. We're in the latter stages of the project. It's rather small. Completion value is about 61 million, which for us is not big, but it should give some very nice returns at that time, Q1 2025. Our second project in the fund is a condo we're building in Toronto. It's actually in my neck of the woods in the west end of the city on the Queensway, situated between Islington Avenue and Royal York Road in Etobicoke. It's 11 stories high, approximately 180 units, and it is a 3.5-year project coming to completion Q4 2026. Okay, you can see the estimated completion value is almost triple that of the townhomes. It's about 155 million. So now we're getting into larger but longer projects. The largest one we have is called Sandstones. It is also a condo being built in the east end of Toronto, 2257 Kingston Road. It's pretty much twice the size of Vicinity. And Sandstones is approximately 330 units on a 1 acre parcel of land, all 12 stories in height, and it is coming for completion Q4 2027. You can see the completion value is even larger, just under 300 million. Right? These projects are highly valuable and, of course, highly profitable. If we look at the results, the returns of this fund since day one, you'll see also it's never dropped in value, and it's been fairly consistent as well, up and to the right. That's what we want to see from our investments, right? Very, very stable, very, very consistent for investors. All right, so now we're going to move on to our development offerings. These are the very high returns that you saw on that overview page on the far right, targeting anywhere between 16 and 20%, could go higher than 20 as well. I've seen many projects do so. Our current offering is a residential asset we're building in the east end of Toronto as well. This project's being conducted at Broadview and Danforth. That's the name of the project, 1099 Broadview. It is a 12-story condo being built on a 1.4 acre parcel of land. It is 5.2 years in length, and the total return is targeted to be just north of 100%, 103%. So remember what I said earlier, the rule of thumb with developments is that on a 5-year project, you double your money. That's what we're seeing here. 5.17-year project with an ROI of 103%. Approximately 355 units in this 12-story building, and the main floor will be commercial, okay? Now, minimum investments, as you can see here, 25K, all of which we've already covered. Now, I want to speak a little bit about how we came across this parcel of land, because Equiton Developments has been looking in this area to build for quite some time. It's a very nice area of the city to be building in. And we actually purchased our 1.4 acre parcel from a major grocery chain that owned the property in the area. And they do not operate their grocery chain on this land. They actually operate down the street. So what a lot of grocery stores will actually do in our country is they will buy adjacent commercial properties to preclude competitors from moving in. And that's exactly what this grocery chain did. They operate 2 streets over in the neighborhood. So they bought this parcel of land. They rent it out as an investment for themselves. However, I'll tell you who they won't rent it to. They're not going to rent it to a competitor, right? A Walmart, Loblaws, whatever the case may be. So this is how they control competition in their industries. So for whatever reason, they've decided to sell the building. Now, when you sell a building, a parcel of land like this in Toronto, you always want to rezone it for residential. You want to submit an application for a condo. This is how you get highest price. What we found is that they submitted an application for a 10-story condo, then listed the building. This area can easily accommodate a taller building. 12 stories is what we think we can conservatively get. In doing so, what they've done when they submitted an application for 10 stories, they've kind of shot themselves in the foot because they put a ceiling on the value of their land parcel. Very, very critical mistake. So we saw this listing a day after it was posted. We right away submitted an offer after doing some due diligence on our end. We purchased the land for 26.5 million, approximately. We've already had this land appraised, and it's being appraised at 32 million. So we've already netted $6 million in profit on the parcel of land acquisition alone. That's very important because that $6 million of profit is going to be a pillow, if you will, to buffer against any potential cost run-ups or anything adverse that may happen in the preceding stages of the project. Now, on this timetable slide that you guys are looking at, I like this slide because it gives a very succinct breakdown of the various steps involved in a development project. First, we're buying land. Then we are going through the site plan approval or the permitting stage. This is where we're addressing any easements, we're filing for land use changes, and again, takes a very, very long time to do this. We budgeted approximately 3 years to get through approvals on some of our projects. This one we budgeted about 2.5. Okay. Once we have that done, we can move on to pre-con sales. Right. And just like any other pre-con sales, we are creating a presentation center. We're building a model home. We have floor plans, price lists. Folks are coming in to see the building. They're putting down their deposits. And of course, once we sell 70% of units, we can begin construction. And that's what we do. Dig a hole in the ground, up and up and up we go, until, of course, occupancy is achieved. Occupancy is when the building is safe to inhabit. Many of you may have gone through this yourself if you purchased a unit pre-construction before, but that's essentially when the builder hands over the keys to the very excited purchaser. It is at that moment that the full purchase price of their condo is due. We take all of this money in, it goes into a giant checking account. We have $300+ million in it. That is the profit that goes back to investors at day one. And then the investment closes down. Everyone goes their separate ways. As you can see, this is a 5.17-year project coming to completion Q1 2029. Okay. I'm going to start to wrap it up. I know I've gone a little bit over time here, but I do want to communicate to everyone here why we like this area. Why are we building at Danforth and Broadview? Well, for those of you in Toronto, I can tell you this. Every year, Toronto Life issues their annual neighborhood rankings, right? They rank every single neighborhood. There's over 50 in Toronto from top to bottom. And this year, or sorry, last year, 2023, their latest one, the Broadview Danforth area, Greektown, was ranked number 1. Not number 2, not number 7, number 1. This area is highly desirable to live in. And the main reason why is it has what I would call the golden triangle. It has the trifecta of 3 major pieces of transit infrastructure, all within a 5-minute distance of our build site. We're within 5 minutes of the DVP, major 400 series highway. We're within 5 minutes of Broadview subway station. It's just down the street from us. And we're within 5 minutes of a GO train station. The Main and Danforth GO train station is the last stop before you hit Union, and we are very, very close. It's exceedingly rare to have this type of accessibility to transit infrastructure. In fact, there are only 6 areas in the entire city that can make this claim. This is one such area, and this is the main reason why people like to live here. The other thing I'll say about the neighborhood is that it's vibrant. I don't know if any of you have spent time on the Danforth, but really good restaurants. The Taste of the Danforth is a fantastic place to spend time. I think they canceled it since COVID, but I hope it comes back soon. It's North America's largest Greek celebration at the end of the day. Really, really nice place to spend time. Good bars, good restaurants, good for students. It's good. It has good accessibility to U of T and other universities, but it's also good to raise a family. It's a very quiet and safe neighborhood. So for all these reasons, very appealing place to live. And this is why we wanted to build in this neighborhood. Now, in the interest of time, we're going to cut it here. I know we gave a lot of information today, and I hope that you retain as much as possible. I want to turn it over to anyone with questions to ask whatever they'd like, no matter how complex or how simple. Happy to go through it with you.
If anybody has any questions, you can raise your hand on Zoom and I'll unmute you where you can go ahead and ask the question to Lawrence.
Yeah.
And while people are doing that, Lawrence, I had a few people that actually asked, 2 of them asked the question because they weren't able to join, so they sent it in. I'll start off with that, and then in the meanwhile, if people have other questions, they can ask.
Of course.
One of them who wasn't able to join, he actually is not a resident of Canada. So he was asking, is there an opportunity for people that are not Canadian citizens to invest in the fund or to invest with Equiton?
Yes. So we have investors predominantly across Canada, but we do have international investors. Ironically, we cannot accept Americans. So if you lives in the States, he cannot invest, or she. But we have investors from many, many other countries, from India, China. I've done an investment for a lovely woman from Iran just about a month and a half ago. The key thing for us we need to see is international investors must have a Canadian-based bank account. Okay.
Okay.
So that is critical. As long as they have that, and they can set one up themselves, of course. It's not very difficult to do as an international investor. But as long as they have that, we're okay.
Okay, perfect. I'm getting another message from somebody, but seems like my chat is disabled somehow, so I don't know how to figure that out. But I have
Okay.
another question that was
Of course.
given to me. So I am just gonna go ahead and ask that myself. In terms of investing, I was asked that are there any tax benefits where you would invest with Equiton compared to other people? So why invest with Equiton, or why, I guess, use your RSPs or liras, your registered funds to invest? What are the tax benefits for that?
Certainly. So when we're looking at registered accounts, so let's take a step back. We can answer the question in two ways. First of all, the tax benefits of registered accounts. Maybe we'll start there. Look, any registered account, TFSA, RRSP, LIRA, RESP, these are all going to be tax exempt accounts, meaning any profits earned in any of those four accounts I mentioned are for you tax-free, period. Okay. So where the tax implications become more important is if you're investing in a non-registered account, what we would call a cash investment. So it's taxable. Now, if I'm doing a cash investment for a client, I am 90% of the time going to recommend our apartment fund, our residential fund, our flagship. The reason why is because of how favorably it's taxed. I don't want to get into the complexities with it today, but I will say that essentially with this investment, you don't pay any tax until you sell it. So you're in a situation where you're earning monthly cash flow every single month, but you're not paying tax on that until you sell that investment. Now, if you don't sell the investment for 5, 6, 7 years, well, you're not going to pay a penny of tax for 5, 6, 7 years. So the investment has a tax deferral quality to it. It's not tax avoidance. You do have to pay it eventually. The CRA won't allow us to not pay it, but you can defer it. And if people have done their taxes recently, I have to think most people have, and they've spoken with an accountant, their accountants will tell them the best thing you can do is not pay tax. If you have to pay tax, the second best thing you should do is defer. Defer, defer, defer. Push it as far back into the future as possible. And with this investment, it's possible to do something like that. The type of taxation that it's called is return of capital. So the apartment fund is taxed as 100% return of capital. So if anyone wants to Google it, or better yet, reach out to you, Majid. We can set up a meeting and I can walk them through it with a fine-tooth comb from tip to tail. That's probably the best way to learn about it.
100%. And to everybody who is listening and that is on the webinar, um, I know Lawrence and I went through everything at a high level, but if and when you have more questions where you want to, I guess, learn more about one fund or the other one, we can always have one-on-ones with Lawrence where he can basically sit with you and answer all the questions, I guess, that you have, which won't be as fast-paced as we were today because we were short on time. But of course, we have that opportunity that we can. And I just made the chat available to everybody. So I just got another question in. And if you have more questions, please write them down
Yep,
and
I can see it as
text it
well.
in. Yeah. So somebody's asking, when does it not make sense to invest? So I
Yeah.
know in the real estate industry, me being an agent, I get this asked all the time: how is the market? Can we buy? Should we buy? Should we sell? But on your end, we're being on the passive side of real estate investment, but managing a fund. When does it not make sense for one to invest or do invest?
Yeah. So I'll answer that. That's a very insightful question. So think of it, I'd like people to think about it this way. We are a private equity real estate investment firm. So when my clients give me their money to invest, their money denotes ownership in the funds and the properties and developments that we operate. So that you're not giving us a loan, we're not paying you an interest rate, it denotes ownership, which is why when the buildings go up in value, the value of your investment goes up. It's the same as you owning your own property. That's how it works. So because we're investing in physical brick and mortar real estate that you can see and touch, I just showed you 2 buildings that we actually own. The real question is, when does it not make sense to buy those types of buildings, right? Because we're buying real estate. The types of strategies we execute are highly correlated to the economic cycle, right? When we see economic expansions, growth, we're going to see these investments do very well, right? Immigrants are moving into the country. There's a lack of supply of housing. People need a place to live. And so generally speaking, real estate will fare well. Where we start to see these types of investments soften on the return side is when we see periods of economic weakness, right? Economics is cyclical. So specifically, we pay very close attention to the strength of the consumer. So what does this mean? We're looking at unemployment rates, you guys. I need to know that the consumer is healthy, employed, and still consuming, spending money, right? Anytime we see unemployment rates start to increase, anytime we start to see real wage growth start to stagnate, so it starts to slow down, this is when we typically see vacancy rates maybe start to rise, which isn't good for our apartment buildings. And it's also when we start to see those late rental payments, and that would maybe precede those non-payments. And of course, that's when we're going into an economic recession. Now, these are going to happen, whether it's now or in 5 or 6 or 7 years. Again, economies are cyclical. So I always caution my investors, if you're investing for the next 2 weeks or next month or year, you probably don't want to be an investment in real estate at all. These are long-term assets. But long-winded way of answering your question, Moazama, we're looking at economic indicators strictly centered around consumers.
100%. Thank you. That was a very detailed answer. So thank you for that. And I have 3 more questions here. I'm assuming you can read the
Yeah,
chat
I
as
can read them
well,
all
right?
too. So
Okay,
Sai
perfect. So
Jiri,
it's
excuse me if I'm butchering your names, you guys. I have to apologize in advance. You said, do you claim depreciation and how to avoid the clawback? So depreciation is actually how we can defer those taxes on the apartment fund, as I'd mentioned earlier, because what we're doing is we're claiming non-cash expenses against the portfolio of assets. So that when we earn income, according to the government, the CRA, we're earning far, far less income. And in some years on paper, we can actually manage to even report an accounting loss, which is amazing because that means zero. Now, again, I'm stressing this is not an actual loss. It is a loss for accounting purposes, which means we're taking into consideration depreciation, amortization, et cetera, et cetera. The reality is, of course, these buildings are profitable. That's where the returns come from. But according to the CRA, we can kind of kick those down the road. So that's how it works. Now, in terms of you, the investor, Sai, you cannot claim depreciation on the buildings owned in the fund. So in that sense, that isn't possible. That is only something that we do at the fund level, and we pass through the benefits of that to investors. But it's not the same as you owning your own property, for instance, where you can claim your monthly HOA fee, your maintenance fee on the condo as a depreciating against your income, or interest expense on a mortgage. So it doesn't quite work that way. Make sense? Next question, I got John Bustard. Is it like a real estate split corp on the stock market? I think what you may be referring to, John, is a real estate investment trust, a REIT. And what a REIT is, if you guys don't know, it's essentially a portfolio of buildings that is traded on the stock market. And that's exactly what our apartment fund and our income and development fund are. They are REITs, they're the real estate funds. However, we're not traded publicly. We are privately held, which means the value of our investment isn't determined by what is in many cases a very irrational market of buyers and sellers, traders, really. And that's important to understand because that's what gives the stability of the investment. You can buy a publicly traded real estate fund, but it's going to behave exactly as the stock market does. It's going to go up on good days. It's going to go down on bad days. There's a lot of speculation. People are buying and selling for reasons many of us retail investors don't understand because it's beyond us. So the private aspect of the investment is what gives it the stability. Now, a follow-up question, John, you might be thinking it. You might be going, okay, Lawrence, well, if the value of your investment isn't determined by the stock market, then how do you value your investments, right? When you say it goes up 10%, how is that even determined, right? Who gets to say? And the mechanism through which we do this is through appraisals. In other words, it's the true value of the property that is reflected back to our investors. As a rule at Equiton, every single building is appraised 4 times a year, quarterly. We do quarterly appraisals on every building. So in the apartment fund, we have 34 buildings. 34 buildings are getting appraised 4 times a year. It is these appraisals that are used to determine the value of the portfolio. The last thing I'll say on this is this. We do not do our own appraisals. We do everything in-house at Equiton. We build our own condos. We do our own property management. However, we don't do our own appraisals. The reason why is because it is a conflict of interest for us to assign the value of our fund ourselves. We hire a third party to do this for us. They have no skin in the game. They have no bias. They're being paid for a service. That third party appraisal is being used to value to value the fund. Excuse me.
during your last answer, you answered, I think, 2 of my next follow-up questions.
They always come in
And
tandem. So I just
yeah,
put them all together.
Yeah, I was gonna ask you who does the appraisals, because that is a question that maybe a lot of people would have. How do you come up with your value? So thank you for answering that. Um, uh, a follow-up that I had in terms of, so you mentioned that, because I was talking to somebody else and they had this question, so I figured I'll ask this now. Um, Equiton is a private fund, not on the stock market, right?
Right.
So you might have answered this, but what is the difference where one is on a stock market compared to a private fund? Because some people might ask, well, maybe on the stock market it's better because it's regulated, or it's like being private. It's so what's the pros and cons to that, if
Yes.
you can
People
answer that?
always, they're not, oftentimes people think that because we're a privately held investment firm, that we're not regulated. And in fact, it couldn't be further from the truth. We are more regulated than the public markets because we have to stand up to additional scrutiny, right? We've all seen news headlines of developers going bankrupt and other firms, maybe some private lending firms that are not paying back they're not making their interest payments, whatever the case may be. We've seen this. We're negatively affected by these bad actors in our industry. So the Ontario Securities Commission, the OSC, knows this. And so they hold us to a very high standard of regulatory requirements. The main difference between public and private investments is how they're valued. Any publicly traded investment, right, which we all own, I'm sure you guys have RSPs or stocks you own in mutual funds and ETFs, maybe you have a financial advisor, doesn't matter. All public investments behave this way. They're valued based on the buying and selling of the investment. The more people buy Tesla, that's the price of Tesla stock is going to go up and up and up. Oh, and then Elon Musk says something stupid and then everyone sells it. And then they report good quarterly results and it goes back up again. And on and on and on it goes. What we see is that with these public investments, they move for very sometimes good reasons and sometimes no reason at all. Sometimes it's just market sentiment, it's emotion, right? People get really, really worried about the future, so they sell, sell, sell. Turns out to be nothing, right? And then the same thing on the upside. People get very greedy. They have very, very strong confidence in the future, right? AI right now, look at NVIDIA stock. It can do no wrong. It goes up like this. It's exponential. So that's going to happen until all of a sudden people realize it's not all it's cracked out to be, and then it's going to go the other way. My point is this: private investments don't work this way because this irrational market of buyers and sellers doesn't dictate our price. It is the appraisals that dictate the price. In other words, it's the value of the actual real estate, which in effect makes it the same as you going out and buying your own property. That's why I kept using that example. When you buy a property, it doesn't go up and down like a roller coaster, like a stock. Whatever the property is worth, that is the value of your investment. And it is stable. It'll go up and down a little bit depending on economics, interest rates, supply, demand, but more or less, it's not going to go up and down 30% in a week. Neither will our investments.
Perfect. Yeah, thank you. It's obviously real estate does go up and down, and people tend to think that there are a lot of external factors that play a role, right? But
There certainly are a
we,
lot of external factors. Anyone that says that real estate never goes down clearly wasn't awake for the past, I'd say, 16 months, right? The thing people, I think, forget to understand is that real estate is always and everywhere supposed to be a long-term investment. If you're looking at your real estate holding over the last 4 or 5 months, 6 months, 7 months, and you're biting your nails because you're nervous, then you should not be investing in real estate, right? Real estate moves slowly. It's not the hare, it's the tortoise. The reality is we're drastically undersupplied with real estate. So our long-term thesis on the space is, of course, bullish because there's nothing that we see that is going to lead to increased production of more housing. They can give all the tax incentives they want. So they, meaning the government, they can try and incentivize builders. However, inflation has increased the cost to construct. We have more and more people entering this country every year, much more than, in fact, the news headlines will even say. And that's over and beyond the organic demand just from us having kids, right? Families are growing. There isn't enough demand supply to satisfy that demand. And even short-term interest rates don't derail that thesis, right?
you're in tune with what I'd also tell my people, that time in the market is where we make the money, and not time out of the market. And supply and demand is always in play, because we as things seem now, we'll never have enough supply, and the demand always keeps increasing. So, um, I think that goes with the saying that like time in
Yep.
the market will. And real estate is always a long-term thing. Like you mentioned, whenever I talk to my buyers and sellers or my clients, and we're looking at investments or what to do, and it's always, if you have an asset and it's doing well for you, let's not sell it if you don't have to, right?
Yep.
Somebody just asks, can I see old sample appraisal reports? I'm assuming the answer to that would be yes, but that would be a one-on-one meeting where we can sit
Yeah,
and
that
discuss.
would
Is that
definitely be
correct?
a one-on-one conversation. Sai, I can tell you if you're listening, we are very, very transparent at Equiton. I provide annual reports to all my clients and quarterly updates with audited financial statements. We are audited, by the way. We are audited by Grant Thornton LLP. They're an accounting consulting firm. They review all of our financial statements before we release them. These financial statements are not only shared with investors, but they're shared with the regulators. So to my earlier point about how people believe somehow we're not regulated, nothing could be further from the truth. We are licensed at the firm level, and I am specifically licensed to deal with these types of private investments, right? That's what my education is for. If you want that type of granularity, Sai, happy to share it with you, but the next logical step would be for us to book a call and we can get you everything you need.
So I will be in touch with you. I have your details, and I will connect you with Lawrence where we can have the one-on-one. It is almost 12 o'clock, so I would like to I know there's a couple of other questions, but I have the questions written and I know who's asked them. So I will get back to you personally, and then I will make that introduction to Lawrence, where you can have a one-on-one with Lawrence, have your, I guess, a quiet meeting where you can ask all your questions, and Lawrence will be more than happy to answer them. Just before we do hop off the call, I do want to thank everybody. I want to thank Lawrence for taking time out on his Saturday morning and spending with us for an hour and educating us as to what the opportunities are that are available to us and how we can get into the market on the passive side. Um, as far as the next steps go, if you guys are interested in having a real estate action plan, I basically sit down along with, eventually Lawrence can sit down with you as well and talk about what the options are. But when I sit down with you guys, we go over it. It's about a 20-minute chat, and I do a financial checkup from the neck up where we figure out what your long-term or short-term goals are in real estate and how we can help you achieve those. And a piece of the puzzle is Lawrence, where he also helps you and figures out how and if the investment with Equiton is the right move for you. So I have posted my Calendly link in the chat. So please, we'll click on that, book a meeting with me. My time slots are available there. And we can have a chat. And then I would love to make the introduction to Lawrence, where you can also have a chat with him. Now, I do these events every 90 days. So if you're not in my system or in my database, please reach out to me via Calendly or my social media. You can reach me at the Majid Lodi on Instagram, and you can will be in touch with me on that portal. So again, thank you very much, and thank you, Lawrence. And we hope to have many of these conversations with you in the future as well.
Thanks for having me, Majid. Everyone, thanks for joining us on a Saturday morning. Looking forward to speaking with as many of you as I can soon. All the best.
Thank you, Lawrence, and thank you, everyone. Have a great day.